Let's say I'm a guy who's in the age of 26, 27, 28. I have some money. What is my allocation that I need to do?
I split the 100 rupees that I would have for investment into 33 in large caps. So you've actually been able to build a portfolio where your returns are mid cap but your risk is large cap.
Interesting.
You and I both have seen what has happened in 1992, 2000, 2008, 2013, 18, 20.
Bad drawdown.
Most people are always fully invested. They never have additional money to kind of buy the dip if at all there comes one.
What are the mistakes or some advice that you would give them?
There are 16 different categories of mutual funds. One of them can be used for overnight parking. Transfer the additional money that you have on a Friday and take it back on Monday.
Overnight fund. Okay.
You will generally hear retail telling you, as soon as I started investing the next 2-3 years, the funds didn't do well. Let's say one very commonly discussed fund in the same space is the Parak Parekh Flexi Cap fund. The typical problem that most investors do is,
Hey guys, so in today's episode, we have Mr. Kirtan Shah, who has been instrumental in the personal finance space. Now, he has also been working in the Treasury Department in the past with an listed NBFC player, and then he went on to start his own finance company. Now, obviously, there is a lot of information in this podcast. We basically cover how to actually find some good mutual funds, what is the checklist for these funds as well, what are some things to avoid, gold, real estate a little bit, and different asset classes as well. We also talk about US investing and what is the best asset allocation for someone who's just started their first job. Also guys, before we start the video, I want to thank the sponsor of today's video, that is Groww. So we are a part of Groww network and they have been instrumental in helping us grow the channel so that we can get the best content back to you guys. So if you want to know more about investing, you can definitely check out the Groww app in the link in the description. So Kirtan, first of all, thanks a lot for coming on this podcast because I know I've been following you on Twitter and I've seen how you're helping people a lot with personal finance. But before we get into all the tips and tricks and hacks on personal finance, I want to understand a little bit about you. How did you start your journey? And now you run a company called Credence Wealth. So how did that come about? And what is the approximate AUM that you're managing right now?
Shashank, first of all, thank you so much for having me on the show. I was actually heading Treasury for a listed NBFC because it's listed, let's not name it.
Yeah.
That's my money management experience for an institution. And that's the background that helps me, I'm assuming so, in whatever I'm currently doing. But while I was a part of the Treasury team then, I would get typically called by B schools and other colleges to kind of come and talk a little about how the industry operates on the fixed income side specifically. That's where I realized that a lot of these premium B schools of sorts and students of that caliber also have very little understanding about fixed income per se and investing in general. Right? That's where I really thought that this probably could be a good idea for me to move into entrepreneurship, where I would end up coaching these guys on any and everything to do with investing. That's where I first started an education setup, which is run by the name called FPA EduTech. And we coach people to clear global exams like the CFA and the ACCAs of the world. In the journey of coaching, there came about opportunities where I was called to train people in the banking and financial services industry. So I would train the insurance agents, the mutual fund distributors, stockbrokers, and all of that. Is when I again realized that if there is so much of dirt in terms of gap in the knowledge, right, for people who actually service in the money management business, right, this can be a great opportunity to forward integrate because I was already in the business of money management earlier, right, and always been extremely passionate about it. But training the intermediaries and banking and financial services professionals in general gave me a thought that probably what I was doing for institution can be well done for the retail audience. And that's the journey of the wealth side of the business where it started.
Okay.
Actually, we've gone through a name change and now we call it Truvanta Wealth Private Limited.
Okay. And when did you start this approximately?
So this is a 9.5-year-old setup.
Okay.
We manage close to 2,400 crore of investments for HNIs and ultra HNIs globally.
Superb. So basically, you're talking about when you did fixed income as well. I know fixed income is not a big trend in India and it's a very HNI trend, right? But do you see that now flowing into the Indian retail market as well?
Oh, 100%. I think thanks to post-COVID specifically, people have at least realized and understood one thing, that FD is useless.
Yeah.
Yeah. Of course, I mean, don't take exactly what I said, but I'm sure you get the context.
On a longer period of time.
Yeah, it does not even beat inflation post-tax, right? And this is a very strong message that I think that a lot of people have really understood over the last 4 or 5 years, and which is why I see a lot of money flowing back to capital markets, right? And which is why you see so much retail participation on the equity side of the business. But having said that, it does not take away the need for you to have fixed income in your asset allocation, right? So what has really changed now is that if not FD, right, then how do I do my asset allocation on the fixed income side? That's an interest area which I have personally seen grow over the last 4 or 5 years, and is where people are looking at alternatives to where can I park my money if not FD, and how in fixed income also can I generate inflation beating returns post-tax, right? So that mindset change is definitely happening. And like you rightly said, it was always an HNI, ultra HNI kind of asset class, right? Because a lot of these guys have a lot of money, and now all they want to do is beat inflation, but make sure that their money does not really go down in a bad situation. But I think I see that trend coming to retail investors for sure.
And what is your take on, let's say, different asset classes? Let's say mutual funds are there, real estate, there is gold, and there is fixed income. So what is your take on, let's say, each of them, if you had to like quickly sum it up?
So I think except for real estate, I am pro all the 3 other assets.
All the 3 other. A balance of it?
Definitely. I mean, will depend on where you are on the risk curve and how much time do you really have in terms of staying invested.
Okay.
But having said that, I think real estate is great to have to stay in, but I don't really think real estate is a great investment opportunity in India at this point in time that you and I talk. A big bull in general on equity, gold, and I think fixed income solves a very major problem for a lot of people, irrespective of whatever you are, even if you're conservative or aggressive. Like say, for example, even if you are aggressive, and I'm typically asked a question when I talk to people saying that I'm extremely aggressive, I have 20 years of investment horizon left, but I still push them to have 15-20% fixed income allocation, right? And I always typically get questioned as to why have this 15-20%. Now, in general, what happens is people have a very surface level understanding that you need to have an asset allocation, right? But somebody who's very aggressive will question that, why do I need asset allocation? I mean, I'm okay with a 30-40% drop on my portfolio, but I'm looking at a higher CAGR. So one thing that I keep telling everybody, right? Suppose if I ask you, are you fully invested or do you have cash available at this point in time?
I am almost fully invested.
Generally, people who understand,
Yes,
right, they're typically always fully invested.
Correct.
Right? But you and I both have seen what has happened in 1992,
Absolutely.
2000, 2008, 2013, 18, 20, right? Look at October 2024 to March 25. Right?
Bad drawdown.
Most people understand that this is a very normal feature in the markets, that markets don't go up linearly. It'll fall, right? And then go up sorts. But most people, because are always fully invested, they never have additional money to kind of buy the dip if at all there comes one, right? So imagine a situation if there is going to be a 40-50% dip, hypothetically.
I would love that, yeah.
Right? But would you have the cash?
No, not that
right?
much.
So then the second argument is that, I have steady cash flow in terms of my income, and we will deploy that. And I always keep telling people that, beyond a point, once you've invested for 5, 7, 10 years, your corpus has become so large that your steady cash flow may not be able to significantly average your portfolio in any sense, right? So that cash flow will not give you what you are really looking at to buy the dip, right? And which is why I think a 15-20% allocation to fixed income is not bad, even for the most aggressive of the investor. Because you look at the last 25 years of data, a 70-30, 70 equity and 30 fixed income portfolio versus a 100% equity portfolio, 25 years of data, the risk, which is measured as standard deviation on the 70-30 portfolio, is 2 units lower than 100% equity, right? Which means it brings down your risk when you have 30% fixed income. And the difference in return is less than 0.5%.
Less than 0.5.
On the favor of equities, right? Okay. So equity has 0.5 higher than the
But that's fine.
70-30. but you can reduce 2 units of risk, right? And almost have the same return. Now, if you add an element to this where you use the fixed income very smartly when the markets are falling and buy the markets lower, by keeping your risk lower, you will easily be able to generate much higher returns than a stagnant equity portfolio. You look at the last 45 years that the markets have been trading. There are only, in my opinion, as far as I remember the data, only 4 years in a history of 45 years that the market intra-year has not fallen 10%. Right? So the remaining 40 years from the highs, there has been one opportunity every year in the last 45 years.
Where the index has gone.
When the index has fallen 10%.
Wow.
Right? Now, if you can play this smartly, I think that 20%, 30% allocation to fixed income can really change and bring you that alpha that you are really looking at.
So just to explain it to the audience as well, when you say fixed income, can you elaborate a little bit more? Let's say I want to do a portfolio now. 70% is, let's say, mutual fund, stocks, everything, equity component. 30% I want to do fixed income. How would you break that?
See, for me, because fixed income largely is used as an asset to buy the markets lower, and I look at it that way.
So it has to be liquid.
It has to be extremely liquid in an aggressive portfolio.
Okay.
Right? So for us, liquid fixed income is only mutual funds. There's nothing else which is, for all practical purposes, extremely liquid and still can be able to generate.
So what type of mutual funds are these? Like, are these those debt funds you're talking about?
Yes. So these are debt mutual funds. As per SEBI, there are 16 different categories of mutual funds on the fixed income side that you can use. One of them can be used for overnight parking, right? Let's say Saturday, Sunday, you don't work. You just transfer the additional money that you have on a Friday and take it back on Monday.
This is the ultra short term something
This is an overnight fund.
Overnight fund, okay.
Right. This is one of the categories. There are 16 such categories, right? Where you can play any kind of fixed income opportunity that you really want to play. But what we typically do is only play 2 types of fixed income. One is credit risk and another is long duration.
Credit risk and wrong duration. What is wrong duration? Understood. What is credit risk?
So credit risk is a fund in which it is expected that the fund manager will deploy more than 65% of the money not in AAA.
Not in AAA.
Not in AAA.
Interesting.
Which means that it will take some credit risk or invest in companies which don't have the best other ratings. Right? That's one side of our fixed income play. And the other side of our fixed income play is long duration. Idea is very simple. When interest rates are going down, you can make capital gains on your long duration portfolio. So when interest rates are falling, our fixed income allocation is long duration. When interest rates have bottomed out and are expected to go, our fixed income play moves to credit. Because in that situation, when the rates have stabled and will start go up, your credit portfolio will do very well versus your long duration. Right? So these are the only 2 categories that we typically use. Of course, this is not a retail
friendly one.
Retail friendly approach. This is a very professional approach, but we believe that we kind of understand what we are doing and which is why we are doing. So this is what we use for allocation to fixed income in our portfolios.
Let's take a retail example because obviously, let's say even I want to learn, right? Let's say I'm a guy who's in the age of 26, 27, 28, first job. I have some money. What is my allocation that I need to do? Because today everyone is 100% equity, right? And they can never take 20% dip. Dekh liya to khatam. So how do I manage this smartly to take advantage?
I'll give you 2 sides of it, right? First is theory. Theory says that, if you are so young and got 30 odd years to go for your corporate career, right? You can probably take the risk, right? So let's say I have 70% allocation to equity and the remaining 30 split between gold and fixed income.
Okay.
Right? That's one way of looking at it. But I'll add a slightly more practical approach to this. Because this is retail and I'm assuming that you're not going to use the fixed income to buy the markets lower. You want a more stagnant asset allocation because you will not be able to do it in general.
Yeah.
Right? Then what you ideally do is have 70-80% equity and the remaining as gold. Now you would say, why not have fixed income? Because 9 out of 10 people in India who are salaried today are automatically building their fixed income portfolio without even them realizing through their EPF, through their PPF, right? Through their NPS, right? a lot of fixed income is already built compulsorily without even you realizing through your salary.
In your provident funds.
In your provident funds, right? So over the next 10, 15, 20 years, you will already be able to build a large fixed income portfolio without even practically planning for building a fixed income portfolio.
Interesting.
So if you're 26, 27, 30 types, got 25, 30 years to go, I would rather suggest that go slightly more aggressive with 70, 80% in equity and the remaining in gold, because your fixed income, like I said, is taken care of with your salary.
Got it. And let's say the 70% is in mutual funds. How would you break that down, assuming aggressive young guy?
So again, I have enough and more data to share with you, and this is what I practically do for myself and all our clients, right? So if there is an individual who tells me that, you know what, I don't understand what has to be done. I have 10, 15 years of investment horizon and I'm okay taking some drawdowns, right? What would you do? And this is exactly what I do for myself and for anybody who tells me this. I split the 100 rupees that I would have for investment into 33 in large caps, 33 in mid and 33 in small.
Okay.
Right? It's an equal weight portfolio across large, mid, small. Right? You look at the last 20, 25 years of data, again, risk standard deviation is 1 unit higher than large caps. But your return is as good as mid cap. So you've actually been able to build a portfolio where your returns are mid cap, but your risk is large cap by equally splitting it across large, mid and small. Right? But the reason why we've been able to do this is because I do this as business, right? So we are slightly more ahead of the curve in terms of how to build this.
Yeah.
Now I'll explain to you why do I make this statement. Suppose if I tell you that these are 20 mutual funds that I love and they are the best in the market, and I tell you to choose 4 or 5 funds to invest in. Even if you end up choosing those 4 or 5 funds out of the 20 funds that I give you, may not necessarily mean that your portfolio is good. Which means a portfolio of good schemes may not make the right output.
So how do I solve this?
Right? So point number 1, scheme selection is very different from building a portfolio. Right? Like say for example in the stocks business, right? Suppose hypothetically, if I add let's say a TCS and an Infosys and a Wipro and an HCL, all of those stocks are great. But does it make a great portfolio?
No.
No, because you are sector concentrated.
Correct.
And stuff like that, right? So putting 4 or 5 good schemes together does not mean that your portfolio is good. So what do I do? 33 large, 33 mid, 33 small. That gives us market cap diversification. Because you are never going to be able to predict which is the market cap which is going to do good over the next 2-3 years, right? So the best is to split across all 3, right? But very importantly, while you are trying to build this, try and make sure that you have value, growth and momentum, all 3 styles of investing put in the portfolio. Now, what do I mean when I say this? There are a lot of fund houses who do value style of investing.
Yes.
There are a lot of fund houses who do growth style of investing. There are a lot of fund houses who do momentum style of investing. Now, in a 10-year period, you will have 2-3 cycles for each of them. Right? Sometimes momentum will do well. Sometimes value will do well. Sometimes growth will do well. Again, you will not know what will do well. Right? So the best way to fight this is have all 3 in your portfolio. Right? Now, the typical problem that most investors do is they look at the last 3 years of return and end up investing in the 4 or 5 schemes that they've invested in. The biggest problem in doing that is you've predominantly invested in all schemes that follow one style of investing. Which means that let's say in the last 2-3 years, momentum has done well, and you picked your funds like this, invariably 9 out of 10 times the 4 or 5 funds that you bought together will all do or are all probably doing momentum style of investing. So you don't get... And which is why you will generally hear retail telling you that as soon as I started investing the next 2-3 years, the funds didn't do well.
Correct.
Because they're cyclical.
And they'll again do the 3-year criteria and again switch the fund to the new 3-year.
Correct. So like I said, having right 4 or 5 schemes does not mean that your portfolio is good. Your portfolio can still be bad while the schemes are good. So 33 large, 33 mid, 33 small, and make sure that it is spread across value, growth and momentum. If you are able to build a 4 or 5 fund portfolio and give all of these 5-6 variables, I think that builds the portfolio
Very
that
strong.
you really want for a 8-10 year of investment horizon.
And how many mutual funds per large per mid? Because I know people who have a basket of mutual funds, 30-40 mutual funds they hold. Basically the entire index only across.
I think that's the worst mistake that you would want to typically end up making, right? Why do you invest in a mutual fund? You invest in a mutual fund because if there are 4,000-5,000 stocks listed on the exchange, you want somebody who's the fund manager who understands to pick 35-40 stocks for you that will work over the next 5, 7, 10 years, right? Now, let's say if you end up buying 20 funds or 25 funds and each of them have 50, you invariably bought everything in the market.
In the market.
Then you might as well do index, right? If you want to buy everything
That
that is
also they will
available in the right? So it does not solve any problem.
Yeah.
Right? So I am somebody who believes that you should have concentrated portfolios because that is what will deliver what you're looking at in terms of risk-adjusted returns from your investments, right? So I am somebody who will always preach and personally have for myself and my client a 4-5 mutual fund portfolio. So in 4 or 5 funds, irrespective of the amount, because this is one very important discussions that people generally end up doing with me. They say, I have 10 crore rupees. And I say, no problem. The same 4 or 5 funds, right? And then when I'm talking to somebody who's got 50 lakhs, the same 4 or 5 funds, right? Now, they think that because the quantum of money is more, they should add more funds.
To diversify.
Doesn't work that way, right? In finance, it's all about percentage, right?
True.
It's not about quantum.
Yeah. Interesting.
So it does not matter how much money do you have. 4 or 5 funds spread across large, mid, small, value growth momentum will give you the perfect diversification that you actually need to carry for a 8-10 year of investment horizon. Got
it. Okay. So now you have given me the asset allocation split, 33, around 4-5 mutual funds in 3 different styles.
Correct.
Now, now I've got all of this ready. Now I'm choosing my mutual funds. What checklist should I follow to understand what is good and red flags, what is bad?
Okay, great. Now, look, I can give you an answer of what I do. I'm not sure how much will retail really be able to.
No, I want to know what you do.
Absorb.
Right? Yes.
Okay, so look, I'm somebody who has 2 things that I cannot compromise on: the objectivity of the fund, right, and the downside protection in the fund. These are 2 sacrosanct in anything that we choose to invest in. Now, what do I mean? Objectivity of the fund means that if the fund manager has said repeatedly that I will take cash calls, I will stand on cash if I feel that the markets are expensive, right? I want the fund manager to do that, right? Now, whether the fund manager is right or wrong is always going to be in the hindsight, right? But if you feel that the markets are expensive and you're still 100% invested, whereas you've been making commentary elsewhere and everywhere that you are very conscious of valuations in the market, right? Then I would want you to do that, right? Just giving you one example of what does it mean to be true to label, right? Or let's say, for example, if I'm a Flexi cap fund, right? You will see 9 out of 10 Flexi cap funds in the market today are pseudo large cap funds, right? 65-70% of the allocation at any given point in time will be in large cap and the remaining will be mid and small. But the name says Flexi cap, right? You have the flexibility to move across large, mid, small.
Depending on the valuation.
Right. But if you feel that the small cap is very well valued, but you are still 65-70 in large cap, makes no sense for me to invest in you, right? So the first sacrosanct thing for us is that they have to be very true to label. Right? They should do what they are saying or what they are meant to do within the category. And the second is, for me, is downside protection. I'm a very firm believer that your returns eventually will depend on how much are you able to save on the downside. All of us know the math, right? If the market falls 50%, markets will have to generate 100% to go back to where it was, right? But if my fund manager is able to fall only 25%, then he will have to go up only 50% versus 100 that somebody else will have to.
Which is already better than most.
Right? So downside protection is extremely important data point that we look at. Right? Now, in this context, what do we see? Right? How long has the fund manager been around in the same fund? Because if the fund managers switched all the data, the quantitative data on risk and return that you are really looking at is immaterial, right? So very important is how true to label are you and how long have you been running that fund, right? Second, when I say true to label, what I also mean is, and very important data point that we look at, that if you are a value style fund, right? Are you getting carried away by the market and taking momentum calls, right? So let's say a value style fund starting to invest in defense. Of course, you and I can argue whether defense is value, not a value, but for all practical purposes, you know what I'm saying, right? Yeah. Because defense is moving up so much, this guy feels left out and starts allocating money to defense, which is not the core philosophy that...
Yeah. And some funds did that recently. They were taking calls on very high over optimistic valuations.
Right. So you don't want that.
Yeah.
Right. Third, of course, what we want to look at is the consistency with which the returns have been generated. Because look, it is impossible for any fund to month on month or quarter on quarter or year be able to beat the benchmark or the other funds in the market. But let's say over a 3-year, 5-year period, how consistently are you able to deliver returns is extremely important, right? So first what we look at is, are they true to label and how long has the fund manager been around? Whether they are doing what they are supposed to do and what they've been saying. That's more qualitative approach, right? The more quantitative approach is to look at the consistency in returns, lowering the risk on the downside. So you look at something called as down capture ratio to try and understand that. How have you been able to do when the markets are doing very well, right? So you look at something called as the information ratio or the up capture ratio, right? We give a lot of significance to something called as Sortino, but that also helps us understand the downside protection of the fund. So you will see largely what we look at is downside protection and whether the fund is really true to label or not.
Got it. And there's also one very common debate on AUM. So people say don't buy high AUM company funds, let's go lower, and then they take up very low AUM companies run by very new managers, and there is a risk again goes up quite significantly high. What is your take on that?
See, while it comes to small caps or micro caps, I am probably with the same gang who believes that, don't try and do very large AUM funds. Whereas just to contradict my own point that I made to you, you look at Nippon small cap with a 60,000 crore in small cap and still amongst the best funds in the market, but there are very few. Right? So in the small cap space, I believe AUM plays a role.
Because of liquidity.
Because of liquidity, right? Which is why you see even somebody like Nippon small cap has more than 200 stocks in one fund, right? Because so much of money, they will not have liquidity. They might have liquidity while they are buying and the markets are in momentum. But let's say the market starts to fall.
They won't be able to pull out.
They will have an impact cost, right? But in probably a flexi cap or a large cap or a large and a mid cap kind of fund, I don't really think that's a problem. I'll give you an example. Let's say one very commonly discussed a fund in the same space is the Parak Parekh Flexi Cap Fund, which has got some 110,000 crore of AUM. And one common discussion that keeps happening is the AUM has grown so big, will the fund really be able to perform? What you really have to look at is not that one scheme, but AMC level AUM. Let me explain what do I mean. Let's talk about a very large AMC which has got 10 equity funds, right? And then you have Parak Parekh which has got only one equity fund. Now the SEBI rule says that each of your schemes can invest in that one stock for the weight of 10-12% of your portfolio. Which means, let's say if this large AMC that we are talking about likes one stock, right? Whatever that ABC stock is. And they have 10 schemes, which means each of those schemes can take 10-12% weight
in that fund.
In that stock. In that stock. So now assume that let's say all 10 funds want to take exposure to that stock, right? Which means all the 10 funds can take 10, 12% in that stock versus this one scheme taking 10-12%. So you cannot look at 1,10,000 crore as one scheme compared to another scheme. At the AMC level, all 10 of your schemes should be compared to this one scheme from an AUM level.
That's correct.
Right? And which is why I think it's slightly more theoretical when people say that in the flexi cap or in the large mid space, AUM will bring the performance of the fund down. Yes, what it will do is, because it's a flexi cap fund and it is okay to have exposure to mid and small, the tail of the small cap will increase. So the number of stocks that they will want to add with the growing AUM may go up. Because let's say if today they have 4 or 5 stocks on the small cap side, with growing AUM, can they do 4 or 5 only in the small cap? The answer is no. They will have to increase it to 10, 12. So the tail or the number of stocks in the small cap space in the flexi cap fund will go up. Now, will that hurt the returns or not? I think that is something to be seen. But theoretically, that can definitely impact.
That makes sense. Yeah. That makes sense. Now, let's talk about gold, right? Because gold has been something that has always been there, but in recent times, it has caught a lot of attention and capture. And there has also been fear in the last 5 years that it's gone up too much, it'll fall down, but it's only going up, right? So that fear of abhi girega is going on. What is your take on gold as an asset class itself?
I think gold is a mandatory thing in your portfolio, at least in my opinion. Why? Because like I said in my mutual fund answer also, we are very cognizant of the fact that we want to make sure that the downside is protected. And probably gold solves that problem for us. Then when equity is falling, you will typically 9 out of 10 times see gold either stagnant or gold moving up, which balances the portfolio, right? Bringing in that quality along with equity returns, why would you not want gold in your portfolio? You look at the last 25 years, gold has given 13% return, equity is given 13%.
Correct.
With lower
volatility
on gold versus equity. Right? You look at the last 25 years, and I can only remember 2013, where gold fell 19.1%, and 2015, where gold fell 4.7%. Otherwise, gold has been positive for the remaining 23 years.
Well, that's a weird phenomenon because when gold falls, let's say 19%, people rush to the stores to buy it because they're like, it'll always go up. But that's the same concept with Nifty. And when Nifty falls, people don't go rushing to buy it.
I think I'll tell you what the difference is. The difference, unfortunately, is your and my behavior towards investing. When was the last time that you yourself or your family or you know of anybody who sold gold when the markets went up? Right? So invariably, real estate and gold ends up becoming a very long-term investment for us where we are not thinking about selling at all. But you look at equity. Unfortunately, it is so liquid. And the way it is looked at, right? People end up selling equity assuming यार इतना ऊपर गया इससे ऊपर क्या जाएगा?
अभी गिरेगा.
So even if, like you rightly said today, right, that a lot of chatter around gold will fall. How many people do you know who's gone out and sold the gold that they have? They might not buy more.
They might not buy. Yeah, demand goes down, but
they might not buy more, but they don't sell. But that does not happen in equity. In equity, if they feel markets are high, they will sell for once and then wait on the sideline. So I think it is the behavioral gap in the way we Indians are brought up with respect to real estate and gold is why we have a very different approach to investing in gold and real estate versus equity.
Yeah, I also think there's a lot of things to play out in volatility also, right? Because I can see 40-50% PF go down. I can't see gold or real estate going on 50% in front of my eyes. So that is considered okay, right?
Absolutely.
Yeah, or else gold also they will sell if it goes down 50%. God knows.
God knows. But I think thanks to the changing macroeconomics globally, I think gold has a lot of levers around, right? And specifically, I think, look, there is so much of chatter where at least over the last 4 or 5 years that people have started talking, why diversify globally? Why should you invest in the US or China or elsewhere because currency depreciates? I think if you have gold in your portfolio, you don't need to do global diversification, right? Because it solves exactly the same problem that the global diversification solves for you. What do I mean? Last 25 years, gold return in dollar terms is 10%, but in rupee terms is 13%. Because rupee has been depreciating by 3% on an average for the last 25 years. So if you really want to play the rupee depreciation game, right, gold exactly it solves that problem for you.
Actually, that was my next question about, do you also tell your clients to have some exposure in the US markets? I'm not talking about China, Japan and all. I don't know if it's possible, but international exposure, would you recommend?
Yes, we do international exposure for clients, but it is extremely selective in terms of what markets do we really look at.
And how do you do that? Like the framework?
So look, the idea is very simple. There are only very few investable markets globally, right? When I say very few investable markets globally, I think I'm talking about two things. Are they larger enough for you to wanting to take a bet like that? Or are there instruments through which you can take those bets, right? I can count on my fingertips for the funds available if I want to invest in, let's say, Taiwan or a Brazil or an Indonesia, right? So is it easy to invest there? Currently, there are not a lot of options. So amongst the larger markets, what do you have available? You have US and you have China, right? Now, unfortunately, China is not investable, right? China, probably if I'm not wrong, while you and I are having this discussion, China is trading at 10 times price earnings, right? India is trading at 22.5, right? It's a no-brainer that you would want to invest in China, right? You look at the last 15 years, India's GDP has grown 2.11 times. China's GDP has grown 3.4 times.
At that large base also.
Yeah. You look at per capita, India has grown at 2x, China has grown at 3.1, 3.2, right? In spite of their economy doing 50% better than India did, last 15 years of CAGR in India is 12%, CAGR in China is 0, right? So, market returns have got probably more legs to it than just how the economy performs, right? And China has its own problem, which is why, in our opinion, it's not investable, in spite of it being crazily undervalued at this point in time. But at the same time, you look at US. A lot of people keep asking me, while you do all the math at 12% in terms of equity to try and figure out how much can the corpus become in the future, how are you so sure that markets will give 12% return? And I always keep giving them an example. How do you decide market returns? Market returns in very simple layman language is how much your GDP is going to grow plus how much is inflation is what you expect that the market will give you. So let's say if your GDP grows at 8% and inflation is 6%, I'm okay in saying that markets can give you 8 plus 6, 14% return, right? Now you look at US. US has been a market for over a century now, right? And it has still delivered outsizing returns than even the Indian markets, right? Why would you not want to, why would you believe that somebody or some country like India with great macros may not be able to do what US has been doing? Now, but US has a challenge in terms of investing. You look at S&P 500 and the Magnificent 7, right, has 35% weight of a 500 stock index.
Very skewed.
Right? So 7 stocks, which are 1.4% of the index, 7 divided by 500, right, has 35% weight. You will be surprised that 60% of the returns that S&P 500 has generated are generated only by these 7 stocks. Right? And which is why our thought and our philosophy in investing in US is only index investing.
S&P 500 types.
Yeah. More skewed towards Nasdaq than S&P.
Nasdaq 100.
Yeah. And which is why I think in the US, index investing really works because with so much of skewness, you cannot have an active strategy that can beat the index so easily. Right? So for us, global investing is a little bit of Nasdaq, right, amongst the other things. But the rupee depreciation play is played by gold investing than global investing.
So then if I had to again add this US investing into my asset allocation kind of a portfolio. So I have gold, US investing and equity. So how would you play this on a...
So equity still stays at 70-80% and gold stays the remaining 20. In that 70-80% of equity that I have, I might have 10-15% to
the US market.
US. Yeah.
That makes sense. Okay, so now I want to get into a little bit of learning, right? So if I want to learn more about things, something that you learned, some book that you read or some blog that you read that actually changed your perception about investing.
I keep telling this to a lot of people that I end up meeting that, while I make a lot of content in general on Instagram and all of that, but my source of learning is largely Twitter.
Okay.
I end up following some very, very, very good people who share some very insightful views on their Twitter handle.
Could you help us with some names so we can also follow?
So let's say if you want to keep a tab on what's happening in the global markets, right? There is this guy called Ajay Bagga that you should follow.
Very good.
Suppose you want to learn global macros, right? You should follow this guy called Ritesh Jain. You want to follow Indian macros. You want to understand government policies around budgets or decoding RBI monetary policy. You should follow Deepak Shenoy, right? I follow some 100 odd people on my Twitter. And if there is somebody who's listening and wants to follow what I do, just go and follow the 100 people that I follow.
I'm going to do that after this.
Right? It's a great source of learning because you get refined, concise and professional views of very large fund managers globally on a lot of things that you would otherwise find it very difficult when you just end up reading it in the pink paper.
Yeah. And what is one last advice you would give the audience regarding, let's say, investing? What are the mistakes or some advice that you would give them?
The biggest, because I see this happening from a behavioral standpoint because I manage investment for clients, right? Yes, when you come to equities, you expect 12% returns, right? But equity is not FD. It does not give you 12% each year, right? A plus 40% in the first year, minus 15% in the second year, 0 in the third year, and plus 32 in the fourth year is also 12% CAGR, right? Now, so when you invest, do not extrapolate 12% every year. It's a 12% average over 5 years, 8 years, 10 years. Why this is important? Because in my opinion, a retail investor can really do much better than a very sophisticated professional in this industry if this individual who's a retail has discipline. And you will only get discipline when you understand this, that 12% is not linear every year.
And this year also has not been great at all. So
0 returns, right?
Yeah, absolutely nothing.
Last 1 year from the day you and I are recording and you
0.
go back to 1 year, we are 0 and minus on mid and small.
Correct.
So if you've come in the last 1 year looking at the last 4-5 years of return,
you're out.
Yeah, you're already thinking that my FD was better.
Yeah.
Right?
Yeah.
And those are the set of people who are actually going to miss out on the wealth creation opportunity.
Wow. So that was great. I think from what I learned today, mainly by talking to you, is one was the asset allocation. How do I find mutual funds? How do I sort them? The concentration of mutual funds, which a lot of people avoid. How do I allocate good amount in mutual funds, gold, how gold is also important, and having some good exposure to an index fund in US by whatever means necessary, right? And obviously stick in the market for a longer period because that is where wealth creation
That's the
is
most
made.
important.
Don't think every year you will get 12%. Nahi hota aisa. But great. And I'm going to follow those people on Twitter as well. And I'm going to stalk your Twitter today and also check some more profiles. But again, Kirtan, thanks a lot for coming here and spending some time and educating our audience into a wealth of information on personal finance. So I hope you guys take something out of this. Yeah. And I'm really appreciate that you're here.
Thank you so much for having me on.
Awesome. This podcast was really amazing by Kirtan sir, and this is why I tell you that knowledge is amazing and that is something that you should always keep absorbing. Again, I want to give a big shout out to Groww for making us a part of the Groww network and sponsoring this channel so that we can give amazing content out for you guys as well. If you want to know more, you can check the link in the description. And also, if you found any knowledge in today's video, you can click on that subscribe button so that we can get better guests and amazing guests on this channel as well.